We're going to move right along. Our next presenter is Paul Markowski. Now, this is a man who has had the ear of some very powerful people over the years. Paul is president of Global Strategies Analysis Group. This is a New York-based economic, investment, and political consulting firm. So he's not only talked to, of course, companies and various governments. He has been an ad hoc advisor to the staffs of presidents like President Reagan and Bush, to Federal Reserve officials. And during the past 17 years, he's been an advisor to institutions in the People's Republic of China, including local governments. He's worked with many companies there. So he's going to share his wealth of experience with us, talking about how changes in China are affecting the global market. Paul Markowski.
Thank you, and that doesn't mean anything. I think what's important is to get a concept of what's really happening in the world. And I spent Monday at the Federal Reserve, and it was quite interesting. And I'm going to tie this into China. We're going to get all this stuff out of the way, you know. If we click pages, well, I don't know, page 2, whatever. I don't know how to click these pages up here, but whatever. It's what we were thinking about 6 months ago, which was basically the world was at risk, and the world didn't understand risk. That was mispricing risk, and sure as shit, come October, the world is falling apart, and Federal Reserve is under pressure. They cut the discount rate, and they lowered the Fed funds rate on September 18th, and in my view, they're going to cut rates again at the end of this month, on October 31st, by 25 basis points, and they may do it again in December at their December meeting. And what I want to talk about is conceptually what makes markets, what makes people think about markets. Why are these markets where they are? Why is the Shanghai Stock Exchange trading over 6,000 with multiples in excess of 50, where the property index is 110 times earnings? I wouldn't touch them, by the way. As much as people talk about the Shanghai markets and how good the property market is, you know, without casting dispersions, there's not a snowman's chance in hell that those markets are ever going to be priced properly. It's all speculative, and I think the issue in front of global central bankers is that the U.S. was the first shoe to fall, and what happens subsequently? Is it Canada? Is it the UK? Is it Germany? Spain, actually Spain was the first shoe to fall, because Spain in June and July, the financial markets cracked. The housing markets cracked. They tumbled. They've been tumbling in the US for quite some time now, over a year. Now, I was showing a client yesterday on a website the value of my house, and I went into Google Maps, and I showed him my house on Google Maps. And it was really nice, you know, 3 cars parked outside of the garage. You know, I said that was the day that my daughter was at the house. And, you know, the Mountaineer was out there, the Subaru was out there, the Chrysler 300 was in the garage. And the other garage was full of my tools, snowblower and all the other crap that my wife's been trying to get out of there for a long time. And I said, you know, the house has gone in value $500,000. $500,000 swing, plus or minus. Now, it's not a big house. You know, it's not a big house. It's worth, you know, over $1.5 million. That's not pocket change. It's not big. You know, it's a little over 3,500 square feet. It's got all this other crap that goes along with it. 2 Rottweilers next door, and growling Rottweilers. I said, you know, speculation. I wanted to sell the house a year ago, $1.5 million. My wife said, no, we don't want to sell. I said, why? I said, it's the top of the market. You know, the Fed's not cutting interest rates for another 6 to 9 months, a year, maybe. And why do we want to hang on to this thing? Well, now you got other institutions, other central banks are thinking about the same thing. In China, in Asia, the world is aflush with liquidity. Maybe not in the United States, but there's loads of liquidity. You know what the problem is? No one trusts each other. The lender doesn't trust the borrower anymore. That's happened since August. And when you misprice risk, that's what happens. Go back. As I said, I don't know how to switch pages on this thing, but I wish I did. Because if I did, I'd show you what I wrote 6 months ago and talked about, no, that's smaller, not bigger. You know, you do it. Go to page 2 for me, please. Because page 2 is a very telling comment. It's where we were 6 months from now. Banking is witnessing 2 sweeping and concomitant changes, and basically it's saying mispricing risk. And that's where we are. It's mispricing risk. That's what I said 6 months ago. Boom. Where were we 6 months ago? The paradigm shift, reserve growth, the market bubbles, baseball. You know, it was a candy store. It was a global candy store. We don't longer have a candy store. Now you want to go in and you want to listen to people, and you say, you're full of you know, you can put the IT on the end. But that's what people were thinking. Everybody thought that the world was a non-ending growth, high growth, market bubble situation that never would come to an end. And you're talking to a guy who on October 19th of 1987 got a phone call at 9:30 in the morning from Alan Greenspan. He says, Paul, what do we do about these markets? I said, tell somebody to buy stock. 2 days later, you know, I was on with Alan every hour on the hour. Okay, so we get in that situation. Then we're in 1994. Paul, what do we do? Okay, well, actually in between it was 1989, but I was actually, I was in Hong Kong. I was out in Stanley Market, and the markets are falling apart. You had the earthquake in San Francisco, you had the stock market falling apart in the U.S. Both things. So I said, hey, you know, Greenspan put. Don't worry about it. All right, 1994, problem. Tells me in December of 93 that they're going to raise rates, and I knew the bond, they were going to raise rates, and that's bond market got killed, bond hedge funds got massacred, as they say. And then in 1998, I get this little phone call at 7 o'clock in the morning. What do you know about the Russian ruble? I said, long-term capital's got a problem with them, don't they? And he said, you bet you're sweet. And that's what we were 6 months ago. That's where we were. And those of you who heard me speak in Shanghai when, you know, Jimmy Rogers was talking up the markets and, you know, presumptively correct because the markets have gone up. But I was saying the Fed has got to lower interest rates. And that's what they're going to do. I think they're going to continue to lower interest rates until they feel a sense that, you see, the Fed's job, and excuse me, I guide you to an article in yesterday's Wall Street Journal by this guy Rosenblum from the Dallas Fed. It was an op-ed column as to why you had the characteristics of the markets that you did. And would you, as a Fed official, like to, or presume that the market would be better off without a Bernanke put or somebody's put to the market? Easy, 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 as they say. And the issue is the question that he raised And this didn't go unforeseen by Fed officials because, as I said, I was down there on Monday talking to them. I'll talk about that in a moment. Was that he said, you have a decision. Do you want to have a situation like you did at the inception of the Federal Reserve, when 40% of the time the economy was in recession, or you want something subsequent to that, when there's stability, and the markets believe in stability. So they were saying why the market shouldn't criticize the Fed for lowering interest rates. And I think you're right. Why should the Fed be criticized for lowering interest rates when this moral thing is an issue that is related to preventing a recession and potentially a depression? Because, you know, unlike the stock market, when the price of a house collapses, that's that thing above your head. That's the thing that's protected your family. That's what your family looks at every day. We have this attic. We have this second floor or first floor or whatever, ranch house, whatever it is. And we have to make our other judgments based on that. Well, okay, so price of houses has come down significantly in the U.S. And while the Fed, Rick Michigan, who's a good friend of mine, one of the governors of the Fed, presented at the Jackson Hole meeting that for each dollar gained or lost in real estate value, you lose about 7.5 cents of consumption. Now, at the same time, at Jackson Hole, I was at a special meeting that the European Central Bank puts together. It happened to be the weekend just before. And we were chatting, and there were econometric studies presented, and it showed that based on, yeah, I'm going to get quantitative here, spectral density functions, that when you do these spectral densities, on the latter years, you have a larger impact. So Rick's 7.6 cents loss is really a 10-cent loss. The others' models were showing 10 to 15-cent losses. And in fact, with the spectral densities timed to the last 3 years, you'd lose 20 cents of spending power for each dollar in equity value lost. Now, that's what's going to drive the markets. That's what's going to drive the global markets. And that's why central banks have got to worry about reining in liquidity. And it's the People's Bank, same thing, People's Bank China. It's got to be concerned about reining in liquidity and what impact that will have on consumption, which is what the Chinese economy is trying to engineer itself to. China is actually a consumption economy. It's no longer just an investment economy. You know, 80% of China's growth is in consumption. It's no longer just in exports and investment. So it's a big thing. And my view is that with real interest rates in China at 6%, because the core inflation rate is only 0.8%. It's not 6.5%. The core inflation rate, ex-food, is 0.8%. So that you have a real interest, a real borrowing rate in excess of 6%. And more important than that is the one-year lending rate for most businesses, Xing out the small guys or the big guys, is twice that. So you're talking about real interest rates of 12%. They're actually slowing their economy. And you're going to, you know, maybe you don't get the 6 or 5. I'm sorry, I'm bouncing up here. But I'm getting involved in here. You know, when you get involved in talking about things, you get this 5, 6%, 7% growth. Rock and roll is here to stay. It used to be said that the Chinese economy is going to grow, it's potentially going to 6 or 7%, then 7 to 8%, then 8 to 9%. And so the economy is going to slow from 10% to 9%, or 8% to 7%, or 11% to 8% or 9%. Let me tell you, Chinese productivity growth is significant. In the foreign-owned enterprises, productivity is growing at a 20% annual rate. That's big. It's the biggest in the world. If you go to the state-owned enterprises that have reshuffled and restructured, there are two parts of the state-owned enterprise system. Those that are moving forward and those that are kicking gas and staying where they are. You've got growth of 10 to 15% in productivity, and you've got negative productivity growth because they're just hiring people to hire the locals. So, we're going to see this weekend a new government in China. And Hu Jintao has actually won. I think even though there are 9 members of the Central Committee, my modicum was if he had 7 members, if there were 7 members of the Central Committee of the party, if there were 7 members, that means he's won full out. He has had the easiest transition of, remember when Jiang Zemin was president? Remember how difficult it was for him to have his 3 things embedded in the Constitution? It was a huge political, am I right? Yeah. A huge political. Hu Jintao walks in 5 years later, snap, crackle, and pop. He's got it. It's a liberal economy. Doesn't mean it's a democratic society. What it means, it's an economy that's open to all the people now. Why did they have demonstrations 2 weeks ago with 4 farmers went and spoke to the foreign press, about the 12,537 signatures that they had on their petition? You think that was done without the central government allowing it? It means that there's a significant transformation going on. In the US, I would call this the left wing of the Democratic Party taking over China. It's a significant move. It is major. It is the biggest thing that is happening. And if it were not for 1989, not for June 4th, this would have happened 12 years ago. But it's taken that long for the party, the military, which we all know runs the country, to weed itself off of that xenophobia. So now they feel much better. And what does this mean? Well, it doesn't mean that the stock market should continue to price stocks at 57 times earnings. It should not. Does it mean that earnings are going to continue to grow? Yes, but you got to be careful because a lot of the earnings of major corporations in particular are based on stocks prices going up. So as a feedback, this is a bubble. And I worry about the bubble. I worry about the bubble, but I also look at the transformation in the government and saying, okay, they're going to do what's necessary to prevent the bubble from cracking the economy. So you've got the who put instead of a Greenspan put. And that's what's going to drive markets. That's what's going to drive the Chinese economy. That's what's going to drive the global financial markets. And I don't know, do I shut up or do I ask questions?
Yeah, 5 more minutes.
Oh, super! Wow-wee!
Go for it.
As my granddaughter says, wow-wee, Grandpa, you can talk for more. She's only 2.5, but she says, you can talk for more. Okay, let me talk a little bit about, let me add something here. Industrial structure, okay? Changing industrial structure, because this is important. If you look at the trade statistics, China, US, China, Europe, China, rest of Asia, the whole bit. You get a feeling that the world is globalized. There's this globalization thing, and I'm not so sure about that. I think that what I'm seeing is that Asia's share of exports to the United States, total Asia, of all the countries in Asia, ex-India, I don't consider them Asia, they're a subcontinent, but without them, their exports have been, as a percentage of total exports to the United States, have been flat. But China's exports have gone up, dollars and the like. And what has happened is that China has become the final producer. So Singapore produces X. They produce a SIM card. But China puts that SIM card in a laptop. Okay? And I know I have a Lenovo. It was just delivered last week. And it's an old IBM, T61. It's a nice machine, wonderful machine, in fact. China is getting the value-added final product, the final dollar kick. Now, do they make a lot of money on that? Not necessarily so, but they get the political grief because the U.S. runs a $250 billion plus deficit with China, whereas the deficit with all of Asia has not gone up. But China is the one. So I'm not apologizing for a bunch of crooks and others who are in various governmental companies and agencies. But what I am apologizing for is the criticism that China's received because of the shift in production, because they have high quality production. If you look at China's exports of high tech and what they call new tech and high tech. There's a little thing called new tech and high tech in their export scheme. There's also another mechanism. If you look at the actual items that they export, really new technology stuff has soared. So they are becoming a final producer of the high-end stuff that Singapore and Taiwan and Japan used to produce, but no longer produce. And therefore, you have to look at your investment structures. When you come down to it, is my company in final production in China? I don't want to be in primary production because that's commodities. And you don't want to be commodities-based because, eventually this China machine is going to slow down. It's not going to grow at 11%. It's going to grow at 8 or 9 or 9.5 or 10. Although, I have to say, as an economist, I've seen forecasts go from, well, China will grow 8% next year. That's down from 9% this year. Or China will grow 9% this year. That's down from 10%. Or China will grow 11% this year. That's down from 11.5%. That's a lot of BS. That's economists. We're all left-handed, right-handed. Who knows what knows? And models say. And so the important thing is that China's economy was slow, but the restructuring is going to be important in the technology and the service sectors. Forget about the manufacturing that they were in. Look to the growth in service and technology that they will be in. And now I probably used up that 5 minutes. But I can wrap it up. I like China. I don't like some of China. Listen, you're talking to a guy who, works with, I don't want to say. But, there are events that take place. I get ticked off at the Chinese. I understand what they're doing, but I don't understand. As an American or as a Canadian, I was here at a conference a couple of years ago at the University of Toronto and defending the position of globalization. amongst a bunch of union people. Woo! You know how that feels? Thank God it was bigger than they were. Man, fatter at least. You know, all 280 pounds of me said so. And that was the issue. We're scared. And they're right. They're absolutely right. But China is not the problem. It's India and China and Nigeria and South Africa. But by the way, you know who owns all those freaking companies? The Chinese. Well, why aren't the Americans that smart? Because they're stupid. They worry about near-term stock market returns, and the Chinese are looking at long forwards. And I'd rather be a long forward investor. My point. Thank you.